This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss the current corporate earnings season and what it means for tariffs and the economy. This earnings season is particularly important for investors as companies report how tariffs are affecting their operations. While markets have hit record highs, questions remain about the impact of tariffs on businesses and consumers. The good news is that many companies are beating earnings expectations and new trade agreements continue to be announced. Over the next few minutes, we'll explore what the latest data and figures suggest about the stock market and the economy. First, let's focus on the positive. On the whole, companies are delivering stronger results than many analysts predicted. With about a third of major corporations having reported their latest quarterly numbers, 4 out of 5 have exceeded earnings expectations. Overall, earnings growth is running at 6.4%, which is notably higher than the 4.9% that was anticipated. What's particularly interesting is how businesses are navigating the current tariff environment. Despite facing tariff rates at levels not seen in over a century, consumer spending patterns remain strong. This suggests many companies are choosing to absorb some of the additional costs rather than immediately passing them along to customers. It's also worth noting, though, that we are in the very early stage of tariffs, and many consumers are believed to have front-run a lot of their spending in an attempt to avoid tariff. So these figures, as always, should be taken with a grain of salt and put into perspective of the bigger picture. Also worth noting, the tariff impact varies significantly across different industries. Some sectors are feeling more pressure on their margins, while others, particularly those that benefit from reduced import competition, are actually seeing improved results. Next, as this chart shows, the S&P 500 has reached many new all-time highs this year. The momentum has been particularly strong recently, driven by companies reporting better than expected earnings and announcement of new trade agreements. While investors may worry about potentially stretched valuations, it's important to remember that new all-time highs are a natural part of economic expansion. That said, some economists are expressing concerns about how trade policy changes might affect growth, with some estimates suggesting potential impacts on the overall economy. However, businesses have shown remarkable ability to adapt, especially when they have more clarity. Now, looking ahead, Wall Street analysts are projecting solid earnings growth for companies over the coming year, with expectations for an even stronger performance as global trade conditions potentially stabilize. Now, regular viewers will know one of our core philosophies is that hope is not a plan. Namely, hoping companies do well despite tariffs or other possible headwinds is simply not a plan. What happens if those companies do have issues? That's where diversification comes into play, having multiple drivers of return so that not all of your investments require strong corporate earnings growth to perform well. Finally, the stock market tends to follow earnings over the long run. As this chart illustrates, when companies consistently grow their profits, their stock prices typically follow suit. Now, there's a lot of mystery out there about the stock market. Why does it go up or down? But taking a longer-term view, it's simple. Stock ownership is just like owning a small business. Say a restaurant, for example. How does a restaurant's value go up? Well, more people eating at the restaurant, having the restaurant's expenses stay the same, being the only restaurant in a neighborhood, and having pricing power all helps drive earnings for the restaurant and hence the value. Stocks are the same way. Now we're seeing some companies face headwinds from current trade policies through higher costs, while others are benefiting from reduced foreign competition. This mixed picture reminds us why diversification remains so important for investors. What's encouraging is how adaptable businesses have proven to be so far. Companies are making strategic investments, improving operations, and adjusting their supply chain to navigate these challenges. Now, for long-term investors and financial advisors, The focus should be on building and maintaining a truly diversified portfolio, implementing what we call a multidimensional asset allocation, as well as following a holistic financial plan. Now, I hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our white paper. You can click the link below or visit our website at dynamicwg.com. You can also email us directly at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.